Welcome to Sachs Realty's Tuesday Night Podcast, where we talk about anything and everything real estate. Each week, we deliver expert information enabling you to make better informed decisions while keeping more money in your pocket. If you're interested in real estate, this is your show. So you believe that this bubble bursting or the collapse, you do think it will involve real estate?
I do. I think no matter what, it's coming down. The question is just how far. The real estate market could fall another 30, 40, 50%. All this stuff is slowly unfolding. A lot of different things are lining up across the equities markets, the bond markets, commodities. So many small businesses are going to go bankrupt through this process. People are losing jobs. We're already seeing defaults start to rise. All this stuff is going to snowball. This bubble is about to burst, and there's going to be a lot of pain for, unfortunately, majority of people. I think there's a lot of downside potential, but it's an amazing opportunity for somebody who's not overextended. This is kind of like a once or twice in a lifetime opportunity to really double your wealth in a very short period of time if you invest properly and protect yourself with risk management.
Hey, thanks for tuning in. Tonight's show is pre-recorded as I am out of the office this week, taking some much needed time off. The live chat is open, so carry on like usual with your great comments, questions, and peer-to-peer engagement. And we'll talk about your epic discussions on next week's Tuesday Night Live show. I know you'll love tonight's guest, but I wanted to mention quickly that this Saturday at 9:30 a.m. Eastern Time, we will release an interview that I recorded with David Rosenberg. It's certainly a show you won't want to miss. So if you haven't already subscribed to our YouTube channel, please consider doing so now and hit that alert bell so you'll be notified when we upload this Saturday's video, as well as all of our other videos. But I hope you enjoyed tonight's show, and I'll see you soon. I love you all, and thanks for giving me the night off. The residential housing market appears to be finally falling apart, and many financial analysts believe that there could be another housing crash worse than 2008. Now, on the flip side of the spectrum, there are just as many that say it'll never happen, that we'll never experience another downturn like we saw in the GFC due to better lending practices, the lack of housing supply, and a stronger jobs market. Now, today you're about to hear from Chris Vermeulen, who's been trading in the markets for almost 3 decades, and his career depends on navigating booms and busts. He's also a real estate investor, and Chris shares his belief as to what may be the perfect financial storm on the horizon and what you should be thinking financially to come out ahead on the other side. I hope you enjoy the show. Chris, welcome to the Sachs Realty podcast.
Hey, thanks for having me. Pleasure to be here.
Yeah, certainly. I've kind of watched some of your shows and dove into your background a little bit, and you've published a few books. You've been trading in the financial market since 1997, including investing in real estate, of both residential and commercial real estate. And as the founder of Technical Traders Limited, you stated that one of your specialties is successfully helping investors survive bear markets, which are downturns. And many financial analysts believe that a market collapse is headed our way. So I guess, Chris, I'd like to start out the conversation with asking, do you believe that we're in a dangerous stock market and real estate bubble?
I do. I think things are very frothy. I love real estate, but I just can't pull the trigger right now. It feels like everything is, the valuations have just popped. Just way too fast. Just like in the stock market or commodity markets, if the value of something goes straight up in a very short period of time compared to how it normally moves, it's not sustainable. Usually that's an emotional bubble. Something's caused it and forced that to happen. And usually it'll fizzle out and you'll lose at least half of that move, if not all of it. So I believe we're in that frothy environment. I believe a lot of different things are lining up across the equities markets, bond markets, commodities, interest rates. A lot of things are unfolding, including unemployment starting to rise. That's leading us to okay, this bubble is about to burst, and there's going to be a lot of pain for, unfortunately, majority of people.
So you believe that this bubble bursting, or the collapse, some people call it, I don't know whether you would say it would be a financial collapse or correction, you do think it will involve real estate?
I do. I think it'll get pulled down. Real estate generally lags the stock market. So I'm very keen. The equities market is very big focus of what I do. And the real estate cycle is much bigger, much slower. I find there's going to be another great opportunity, kind of like 2012. That's when, the last kind of major real estate bottom was in 2010, 2012 was when I picked up properties. And I feel like we're finally getting to another point where we're going to see that opportunity again. I really like the real estate space, but it's going to be a difficult go here for a bit.
And we'll talk more about, the bottoms because, I went through the GFC and as a contractor, as a real estate agent, really selling my own product back then. And when the bubble finally burst, well, for me as a home builder, it really happened in about 2005. We had headlines of the Baltimore Sun here in Maryland that said the overpriced Baltimore housing market. And from a new construction aspect, which I want to dive into and look at some charts with you, we saw the biggest dips starting to happen almost instantaneously. So 2005 in the new housing market sector, it wasn't until about 2007 into 2008 when we saw existing home sales tank. There was a lag effect that was happening there. But do you think we'll actually see something? I mean, I've heard you say it on other people's shows that you think it could be worse than actually what we saw in 2008.
Yeah, I think it could be very similar or worse. We'll have to see how it unfolds. But I mean, real estate in my area is already down about 16 to 20% from the 22 highs. And we haven't even applied any pain. There's barely any pain in this market right now. So it's really just in this like topping phase. Things are losing momentum. My little town used to have like 60 to 80 homes for sale. Now there's over 600 homes for sale, and they're just not selling. They're constantly, prices are getting cut. So all this stuff is slowly unfolding. I think the markets could fall. The equities markets could fall another 30, 40, 50%. Not the equities market, the real estate market. But people need to realize it's not so much going to maybe be a huge bloodbath. It will be for people who bought literally at the peak. But if you think about it, even for the equities markets, both home prices and equities have like doubled in price. And technically, if you just unwind the COVID bubble and all this stuff, we'd just be back to kind of where we were before. So unfortunately, people who got sucked into buying at a premium are going to get hurt. But really, we might just reset back. A 50% correction is really just going to set us back 3 years in real estate pricing to some regard. So it's not like it's going to be a massive bloodbath. It's just, hey, 3 steps forward, 3 steps back, and then, move forward. That's the way I'd like to look at it anyway. I don't want to think, the world's going to fall apart and all hell's going to break loose, but it'll definitely be a reset for a lot of individuals.
Well, if we go back to pre-2019 levels, I mean, like you said, that's going to affect 25 million people, buyers, home buyers that have purchased homes in the last 4 years. When we look at their mortgage to the max, a lot of folks only put down the minimum of 3 or 3.5%. A lot of them were VA buyers. They didn't put any money down. They owe a lot of money. And I think one of the things that we watched happen in 2008, people want to say, well, it was just a subprime bath and we were just giving out bad loans. And though that did exist, it was really like a perfect storm. I mean, people were getting out of the stock market because it had crashed. They were investing in real estate because that had never crashed before. But there were some people that were just basically giving back their keys because the house across the street, the same as theirs, was being now sold $150,000 less than what they owed on it. So I guess, Chris, the biggest question that I have for you, being an expert in the markets and understanding the banking industry and understanding the dollar, the US dollar, all of which I want to dive into with you today, knowing what the government, the federal government has done since COVID with all of the prop ups, when we're talking about the mortgage moratorium, the bailouts, the modifications, and all kinds of things like that, with their ability to print money. We watched them print more money in 2 years than they did in 200 years. What do you think will be the catalyst that will, push this housing market into a 50% price decline?
Yeah, so I try not to look too much into like the economy, the whole, and what the Fed's doing with rates and stuff. I really follow price, and it doesn't matter. Like the great financial crisis, all that stuff. Everybody says is we're not the same, but to me, when it comes to money, it's the same thing that unfolds. Everybody, as you just said, they always buy the house that's right at their upper limit. They're always maxed out. And as soon as the economy starts to slow, like right now, we're starting to see unemployment start to rise. Full-time jobs are starting to get cut. And when we look at all these things and you look at the trends in the charts, people just start to run out of money. They can't, like credit card debt is defaults are starting to rise. That's kind of the first spot. People are like, well, I'm not going to pay my credit card. Eventually it gets bad. They can't pay their mortgage. Again, more people lose their jobs. Businesses are already slowing. They already think the SP 500 sales have topped for companies, meaning all the forecasts are getting cut. So companies are going to start laying off people, cutting hours. And it just bleeds all the way through from being overextended to not paying credit card to eventually you can't afford your mortgage or your rent. And whoever owns those properties is going to have to, get rid of it or default. The banks hold it. So it's just the same wave all the time. People are greedy. People always get overextended. They don't understand risk. And that's what I specialize on is managing risk and never getting to that situation. So if we have this huge financial correction, it's actually an incredible opportunity for real estate investors, equity investors. But the problem is no one really understands the volatility and the risk that they carry with their homes and their portfolios of other things. And eventually it catches up to them and it's too late by the time it hits them. So it's really just the wave of overextended people can't service debt, and eventually trickles all the way down to the banks. My father was huge with his partner when I was growing up. They had over 1,600 units across Canada, and they had apartment buildings, gated communities, you name it. They had all kinds of stuff. And my dad had a box of stuff that the banks would send him saying, like literally a booklet saying, pick something, give us an offer. And so I kind of based like a lot of my education around what my dad did and looking at what the banks say, just put an offer on this and we'll probably take it. And they would buy up these apartment buildings. I think we're going to go into the same type of thing where the banks are going to have all these properties that are going to be like half the value or 30% less, and they're just going to need to liquidate. So I think there's a lot of downside potential, but it's an amazing opportunity for somebody who's not overextended and understands what's unfolding. This is kind of like a once or twice in a lifetime opportunity for most people, because it might happen when you're young, but you don't have money. And then it happens now when you have capital and you have assets. So if you manage them, this is the time you're going to have this once or twice to really double your wealth in a very short period of time if you invest properly and protect yourself with risk management.
Yeah, well, with the real estate, I mean, if you're a buyer and you've been sidelined and you're still saving and you're not doing your doom spending like so many of the young people are, they're like, well, I'll never buy a house. I'm just going to go to, Mexico or, go on vacation and blow my money because, I'm not confident that I'll ever own a house. So on the flip side, not just investors, the buyers, that if they are smart and they're protecting their credit and they're keeping their debt low, it'd be a good time for them as well. Don't you agree?
I think it'll be great. I think it's going to be, I know a lot of people that don't have a home right now, a house, and they're looking and they're waiting and they see how I explain things and they see how things unfolding, and they're hoping in a year or three, they're going to have an amazing opportunity. This real estate wave is going to take a while. I don't think it's going to be like a collapse. It's going to just a slow bleed out. Eventually, there'll be so many homes on the markets. It'll pick up speed near the end as everything does. But I still think we're like 2 or 3 years out from a really great real estate opportunity. And people who never thought they'd be able to afford a house will be like, holy crap, I can afford a small condo. I can get my own spot for what? So the doors will open and there'll be lots of inventory. I love multifamily property. So, you got a duplex, tri, quad, whatever, apartment building. You'll be able to pick what you want, something with a garage or workshop, so that opportunity is going to come, but you really do need to wait. And this is a lot of entrepreneurs, a lot of people get in the real estate space and the stock market for that matter as very savvy, very successful people. And in the stock market, they get hit really hard because entrepreneurs make stuff happen. And when you get in the stock market, you can't just make trades. You can't just force trades. You have to sit back and let the markets, let the setups come to you. And it's painful to sit on your hands and sit on capital waiting. And it's the same with the real estate market. People will get sucked in. And I know a lot of savvy investors and entrepreneurs who bought properties in the last year and a half, thinking they're going to do all kinds of stuff. Some of them bought a piece of property for a fortune. They're going to build a house and then flip it, thinking they're going to make like 600K. They just had to like give back the property because it's not going to work. So the key here, even in the real estate, is you have to be patient, let these cycles unfold, and be excited to know that things are unfolding and coming, and keep your gunpowder dry.
So let's talk about job loss. I know, Chris, that one of the things that I've always said that has propped this market up so far is that we haven't really seen high unemployment. And, I hear people say all the time that they feel that the unemployment numbers are not accurate. Yahoo Finance published an article late last year or the beginning of this year saying that I think it was 429 or 39,000 jobs were misstated in 2023 alone. And I've heard you mention, in fact, I think you have a chart on that where, you've showed where despite the government pushing up these jobs, there you go. Can you tell us about this chart?
Yeah. So there's when you look at unemployment, it's pretty interesting how things are unfolding. In fact, we could, if we were to take a look at the 24-month moving average of the unemployment numbers, the red line is every time unemployment gets above the 2-year moving average. And so we pretty much have a recession. We have a reset in the financial space every time this happens. And we've seen this. We just saw this. So we are definitely heading in the direction that people are losing jobs. We're already seeing defaults start to rise. People aren't buying expensive homes. Things are slowing down. And then, of course, we can go into government jobs, as you just mentioned there. We start to see government jobs skyrocket. It's almost like the government's always trying to keep things going, keep the music going, kick the can down the road. But even though they're creating lots more jobs for the markets, we're starting to see full-time unemployment. So we have been seeing people start to get more part-time work, like laid off, reduced hours. Now we're seeing people just be like, you're done. Our business is slowing. We're cutting people's jobs. And of course, tech bubble, the financial reset, COVID, and we're back into this phase. So this is definitely not a good sign. This is kind of a leading indicator. This is where the credit card debts are going to start to pick up. The defaults, and then lead over to mortgages. And, if you look at, this is a cumulative of excess savings in the United States. Right after COVID, there was lots of savings because people couldn't do anything. They were trapped in their homes. And now here we are below where their savings are. So people have burnt through their savings. Inflation is through the roof. I don't care what the government or Fed says. It's way higher than what they say it is. And so people are just burning through their capital, and more people are losing their jobs. So all this leads me to believe is like, we're pretty much stalling, and the momentum is shifting where unemployment's going to go up, and home prices are eventually going to go down. I think this will be good for the rental market for a little while, simply because people are going to have to sell their homes and they're going to have to go rent. So the rental market, I think, will hold up and be very strong for a while, but eventually everything will get hit, and home prices and rents have to drop because people won't be able to afford it. So that's kind of how I see that unfolding.
What do you think about, you talk about the investor side of things and the multifamily. You think there's going to be a big need moving forward? And I only say that because I think about your friend that just gave the property back, where you had said, he was going to build something and then it didn't work out. What do you think about investors and builders building smaller multifamily housing for owner occupants, something less than 4 units? I mean, if we're looking at a time of, incredible unaffordability, and the reason I say that is because I just recently sold one of my properties, and I've been kind of liquidating my residential portfolio and getting more into the commercial aspect of things. But I had one particular house. It was a 2-unit, and it was legal. So, what we see a lot of times in the Baltimore area is that they're multifamily housing that are being advertised 2 units, 3 units, but they're not legal. The previous owners, they didn't go through the zoning, to make sure that they could have that, as a multifamily dwelling. And a lot of these investors have purchased these properties to be really burned on the backside of it because they had to return it back to a single unit dwelling because they couldn't get multifamily use. Well, with this property that I just sold, it was actually a legal 2-unit dwelling. But my tenants had been in there for more than 10 years, and I wanted to protect them. I wanted to sell the asset while the prices were high, but I wanted to protect them because they had been such great tenants. So I gave them a 2-year lease, and we still ended up selling it in a day to an investor that bought it as is, gave me what I wanted for it, and no inspection. Because they knew what they were getting. But I had so many people that flooded in. I mean, literally a dozen or more people the first day that all wanted to live in one unit and rent the other. Some call it house hacks. It's just real estate investing. Living there, they can get a good loan. They can get a nice owner occupied 30-year fixed rate mortgage. Do you think we'll see more of this trend in the future?
Oh, for sure. I'm big on multifamily. I built a self-storage facility. I love having multiple doors. 10 people don't pay, or you got 10 units, you're not broke, right? You're not left with a single family full mortgage on your own. I built a brand new property. It's right now it's got 2 major apartments upstairs, beautiful spots. It's got a basement apartment ready for one more. They're legal, which is where the value is to me. In our town, there's all kinds of old skeleton homes that have been retrofitted, and they all say they're 2, 3, 4 units, and they're not legal. And you're going to buy it and you're going to get burned. And if something happens, you're in serious trouble because they never meet the code of any safety, like they're old bones. But I have one of my friends is, I think, moving to our province. And so him and I have been going and watching the properties. We actually take snapshots of the properties in town, of the duplexes and up. And then we value them. I create my own little kind of thing where I say, okay, it's this side of town. I like this, I like that. And we're watching the prices come down. And I said, he can move into the small bachelor pad. He's just a single guy, and then rent out the other 1 or 2 apartments. And he'll be able to live there for almost free, if not free, if he does it right. And he can bring the property up to par. Because the idea is, I'm an entrepreneur. I like to buy, something that needs some work. You add value, right? And I like the part of transforming things. So I'm like, buy one of these, you live in it, you bring it up, your tenants just eventually love you because you've got this beautiful garden and property, and you're adding all this value, and you're going to be able to live for free, and you have passive income, and the property's going up in value. That to me is the way to do it. If you're not in the real estate space already, if you don't have property, and you're on that lower income, you can't afford your own. It's really the way to go, in my opinion.
I hope you're enjoying Chris so far. I just wanted to take a minute to let you know that this episode is brought to you by SachsRealty.com. If you're looking to buy or sell and you're in Maryland, we hope that Sachs Realty is your choice to help you through your real estate transactions. And if you're anywhere else in the country, simply go to SachsRealty.com, check out our interactive map of the United States, click on your state and city to find a real estate agent that we trust. Our nationwide network is brand new here at Sachs Realty, and if you're not finding a real estate agent in your city, please send me an email directly, and I'll be sure to connect you with an agent in your area. Now back to the show. Before we move on, I want to get back to unemployment issues because, I'm wondering, because I'm in the same camp with you as far as, the numbers don't work, things don't seem to, make sense. You're in Canada, we're in the U.S., but you follow the U.S. market, you invest in the U.S. We kind of follow you. I see where, you boomed before we did, and you're starting to plateau and bust, and now we're starting to, you've been there, now we're starting to do that. I'm not sure whether they do this in Canada, but with working with the U.S. markets, the government is really good at avoiding foreclosures for people. I mean, they've got this new, Chris, program out. I don't know if you've heard about it. Well, it's not a program yet. It's proposed. So the CFPB, which is a Consumer Financial Protection Bureau, this new proposal is actually going to increase the protections for those that are facing foreclosure. And this have you heard about this?
No, I haven't.
So this is coming now, as you do know, behind more than 4 years of debt relief, including loan forgiveness programs, mortgage moratoriums, and mortgage modifications. I mean, do you think when we're talking, we're saying the numbers don't work. It looks like things are crashing. The buyers are definitely pulling back. The appetite's not there for these prices. Do you think that the U.S. government, is going to continue to put these stopgaps in place to prevent prices from declining? I mean, the banks are involved here, right?
Yeah.
I mean, lenders, the big money is involved. I mean, what do you think? You think they have the ability to do it, or do you think they'll just flat out fail and ultimately we'll just see massive foreclosures?
Yeah. I think the large financial institutions, the big banks, will be more protected. I think the regional banks, which if you look at the stock prices between large banks and the regionals are struggling. They're probably not going to find the government support, whereas the big majors will probably get support. I'm when it comes to like games and everything else, I like to do everything by the book. I like to play by the rules. I can't stand cheaters, and if somebody's going to lose, they should lose. So I have a very probably a lot of people won't like this, but I hate it when somebody who works very hard, protects themselves, grows their wealth, and then, we're going to get into a reset. It should be an opportunity for those who are savvy and have spent the time and education to do it. Yet all those who don't do anything and they don't understand it, they all just get these give outs and they get saved every time. But, so I would like a reset. If you can't afford something, let's let the markets reset. We need everything to reset. And that's how people learn lessons. I mean, I've gone through a bankruptcy before, stronger now than ever before because of it. Yet it's just like kids in school. They all win. Doesn't matter if you're the loser or not. You don't pass something. Everybody gets a ribbon. And it just makes nobody learns anything. Things get worse. So I want to reset. And as much as it sucks for most people, resets are what make the world stronger. You get up and you're stronger, more educated, and things evolve better. But the problem is they keep putting programs into place to save people who don't put the effort and time to manage their wealth. And if you don't do it, I think you should. If things go bad, well, you should have to suffer. It's a game. It's just like any other sport. Investing, real estate, life. It's all a game. You either win or you lose. But they keep making it so nobody loses, which really sucks.
Yeah, some people, and I don't want to sound conspiratorial or really go down that path, but we look at one of the things I completely agree. I mean, at some point you have to learn your lesson. I don't think it's right that if somebody paid their student loan off and because they were driven and got a good job and didn't drop out of school and was stuck with all the debt and then decided one day that they shouldn't have to pay it, or the government says they shouldn't have to pay it. I mean, I think that it really sets a bad precedence on moving forward, because a lot of people, and I'm hearing them say it, they're like, well, I'll just rack up a whole bunch of debt and it'd either be forgiven or I'll just go bankrupt and, it'll get wiped clean and I won't be penalized. And I'm not saying that with what you had disclosed with your bankruptcy, but there are people that are thinking that they're going to build wealth or debt rather to just do something like that. And we see people living in houses for 5 years, for 7 years before they're finally foreclosed on. But then on the backside of it, we watched what happened with the short sale programs that the federal government back in the Obama days put into play, where they bundled up all of these, bad loans and sold them to Wall Street type companies, right? And they've really haven't seen a downturn until just recently. I mean, they gained appreciation on these houses. They were only going to keep them for a year, and then many of these corporations just continued to keep them and rent them for profits, which I get it. It's supposed to be capitalism. But what do you think about, and again, I'm not trying to be, some conspiracy theorist here, but some people say with all the Fannie Mae already bundling up the non-performing and reperforming loans over the last 4 years and already selling tens of thousands of these loans to, institutional investors. Do you think there's any thought that this is just going to continue and that these houses won't actually hit foreclosure? They'll just be bundled up and then institutional owners will just own more of the single family houses in America?
Yeah, it's tough to say. I mean, I think no matter what, anybody who's holding bad investments and they know it, they're going to try and bundle them up and put them in a nice package and put a bow on it and try and hawk it off to somebody else. That's the world we're in, right? Nobody wants that. So it's always going to happen. The question is, I guess, do we go into a big foreclosures? Do we have all this big wave come through? I mean, we're not going to know until it happens or if it happens. But either way, home prices will come down because of all of this, whether they foreclose or they just sell for really cheap and or the values come down. The values are coming down, and that's all that really matters for me as an investor. I follow price. If something's going up and it's strong, I want to own it. If something's going down, I don't want to own it. I'll be waiting. So I see real estate coming down. No matter what, it's coming down. The question is just how far. There will be a point where there'll be a great opportunity, fair value, numbers make sense, and you can pick the type of properties that you want, that you're comfortable with, and move forward. So we'll have to see if it implodes or if it just has a big correction.
Yeah. As a financial analyst, how do you identify when the buy time, like if you're a buyer, regardless of whether you're a small investor sitting on the sidelines, real estate investor, I want to get to the stock market here, but, just kind of staying along with real estate, what are the buy signals for somebody like you? Because obviously, you can't time the bottom, but what are some of the things that when you are looking at it, and prices are declining, when do you pull the trigger?
Yeah, I think a lot of it does come to experience, like feel and momentum. I'm big all about momentum. I'm always tracking things, so I understand when stuff's coming down and when it's flatlining, and I follow sentiment of what investors are doing. So there is a feel to it, and that plays into kind of the real estate. The real estate is very slow. It's not like you pick a bottom and it takes off. It's you kind of buy in a zone, saying things are now fair valued. So for me, real estate I think the stock market will crash first. Then we're going to see the housing market kind of get sucked down, and the stock market will probably bottom well before the real estate does. So stock market's the leading indicator in most cases. And so when all that happens, then I'll be like looking at the real estate going, okay, well, look at all these awesome properties. The numbers actually work, no problem. It'll be difficult to get mortgages because we'll be in a difficult financial situation. But if you're a savvy investor, you can plop down 10, 20, 30% on it. It'll be fair valued. And then once it's filled up and running, you just refinance later and get a bunch of that capital back and all that stuff. So it'll come down to just watching prices kind of bottom and start to stall. Like you track pricing of specific homes that you're looking at. And when they're kind of leveling off and there's lots on the market and nobody's interested in them, that's when I'm in. That's when I want it. Usually be terrible headline news that real estate's down the most, worst investment in the last 10 years, or whatever the headlines will be, right? That's when I'll be like, okay, so we're finally getting here. And if the numbers work, and the key to me when you buy real estate is buy something with good bones. I built several years ago my properties so they're solid. They'll be good for 40 years of passive income and the value. So don't go and buy an old jalopy that's got lipstick on a pig. Buy a nice quality home that's going to last you 10, 15 years, 20 years easy without it falling apart. And look at it as a long-term investment. I'm not a believer of flipping investments. I believe buy something really good, make it passive income for life, have these massive nest eggs that if you ever need $1 million or $2 million, you just sell one of them and you get that lump sum to go do whatever other, project you're into next. Cause that's really, once you become a good investor, you're really just moving to passion projects. You sell something to rotate into something you're more excited about now, right? That's how I do it anyway.
Yeah, and so taking the information that you just gave and the advice on the investor side. So from a home buyer, you would be looking, if you were advising a home buyer at that point, maybe you would say when the mortgage payment equals the rent payment, or when, your rental payment would be your mortgage payment, then that would be what you would consider time to buy?
Yeah, I would like it to be positive cash flow, naturally, especially if you got multiple places. I don't want stuff to always just be breaking even. I kind of always want a buffer. That's just the way I am. I don't like to ride to the edge of zero in the hole. So yeah, the numbers to me, you should turn a small profit. It doesn't have to be huge. If you could turn an extra $200 or $300 profit on a property every month, then you're building at least a little buffer to fix a fridge or all that, stuff goes downhill. The more the buffer, the better but yeah, you definitely want it to cover all the costs and have a little bit of a buffer. There's no point in riding the fringe, on it being, positive, cash flow positive or not.
All right, good advice. Well, let's talk about the stock market because I know, one of the interesting things that I've learned about you is you kind of with your recommendations, and the money that you're investing, you're kind of like all in on one specific thing. I've heard you talk about, being diversified
Mhm.
and that not really being your lane. You find a where the trends are hot and where you believe things are going and you double down on it, you go all in. And probably you're one of the first that I've hear talk about this kind of, concept, and it works well for you. You said that your downside is you haven't experienced anything less than a 6%, right, decline on your investments, where some people are losing 30-40%. But and I'm very limited. I speak on this with very limited knowledge, Chris. I haven't been very good at investing in stocks, and I know you don't believe in investing in one specific stock anyway, and that's probably where I screwed up, is not having a good advisor. But tell me what's going on. I mean, why do you think that we're in for a stock market crash? I mean, everything to me, I as a layman in this lane, I can look at it and say, well, if I look at the stocks versus their income, their earnings, it seems very overweighted. It seems like if I were investing in the stock market right now, it
Mhm.
would be extremely risky.
Yeah, you bring up some good points. I can share my screen and show you kind of an infographic that I created that really shows kind of where we are in a nutshell. So, without getting too much into details, at a high level, there's four stages in any asset class. This is not just the real estate. This is stocks and bonds and currencies, you name it. There's four stages. Long story short, stage one is a sideways base. It's you don't really want to touch it. It's dead money. You want to wait for stage two, which is a bull market. So whatever asset is rallying. Stage three is a topping phase. Stage four is a big decline. And stage four is green because it's an opportunity. We make money as investors when something is trending up in value or if it's falling in value. We can take advantage of falling pricing. And right now we are in this stage three topping phase. Now, the stock market is kind of got this camouflage. It's very good at throwing people off. The AI, the tech bubble has the major indexes hitting new all-time highs, but the reality is most stocks and sectors are actually trading just like this. They're trading sideways and slowly moving up. They topped out in 2021 and the markets are struggling. So a lot of people think we're in a new major bull market, but we're not. We're actually on the verge of going off a cliff. And when we take a look at kind of the cycles, when we look at there's two cycles here. The blue one is the stock market cycle. The yellow one is the economic cycle. And right now we've got gold, precious metals trading at near all-time highs. Gold is the key kind of defensive play. Energy stocks are trading right up at all-time highs. Industrial capital goods are also trading up at all-time highs. All three of these are performing and they've come to life. And this usually happens right at the end of the stock market for a bunch of different reasons. But long story short, these have come to life. Unemployment's starting to rise. So we're kind of right at this topping phase where the different assets are all performing the way they typically do at the top. And we're starting to see the economic data starting to confirm saying, hey, things are slowing and starting to change direction. So we're getting very close to a big market reset. And I don't believe in holding multiple assets. A lot of people will hold a ton of individual stocks. They'll hold a bunch of ETFs across the stock market and they say, hey, I'm diversified. But the reality is the stock market moves like the ocean. When the tide goes up, it lifts all boats. Well, when the stock market goes up, you naturally want to hold any stock because they're going to go up. But when the stock market's going down or the tide is going down, everything goes down with it. And so that's why I don't want to be holding stocks if the markets are going down. And a really good visual of this actually is you look at the weekly chart of the SP 500. And this is kind of my ETF kind of tide strategy. This tells us when we are in a rising tide, we want to naturally hold equities. When we do not want to be holding equities because the tide is down. And right now we're in a rising tide. But again, most stocks are struggling. It's just technology doing all the heavy lifting. And we're seeing those weird pockets of gold, energy stocks, and industrials do well. And industrials are interesting, Todd, because what they are people buying like assembly lines, equipment for their warehousing. They're buying all kinds of industrial things, because they just had a very strong run from COVID. And these factory workers and these factory managers are all thinking, hey, business is strong. Let's upgrade our facility. They think they're going to continue to grow. They don't realize it's about to stall out. And so all these industrial companies have got amazing earnings because all these companies just upgraded literally at the peak of the economy. And 2 years from now, a year from now, they're going to be like, why did we spend $12 million on this new line? Our old jalopy will keep up with demand right now. And it was fully paid for. And then they're going to default and then they go bankrupt. Like so many small businesses are going to go bankrupt through this process. And of course, then there's a lot of unemployment, right? So all this stuff is going to snowball. And so when we look at the stock market, understanding the stages, what asset classes do at particular times, it is pointing to, we are just in this topping phase on the verge of cresting and starting to go down that wave of a doom for a lot of people.
When do the investors start to pull out? I mean, when does the lag effect catch up? When you're talking about a lot of their earnings reports have not, been published, and what point do you see where, is it the end of third quarter when we're going to start seeing this show up?
It's tough. I do think this year, by the end of this year, I think the economy will have kind of really changed direction. I think people will be like, we're in a recession, or we're already headed, we're definitely headed to one. It's tough to say. These are usually multi-year cycles. Like the fact that I showed the tide going up and down, those are small waves within the overall economic cycle. So this economic cycle has lasted, a decade and change. It's going to take time for this to unfold, and it can drag out, a few quarters longer than you expect. So I would think by the end of this year, it'll be pretty clear, but it might drag out longer. The governments, the Fed, they always throw stuff in place, keep kind of propping things up. But the momentum is stalling behind the scenes. When you look at all kinds of different things, we're definitely getting to the point, like interest rates are, I think topping out here. Bonds are oversold. I think bonds will be a great opportunity to safely sit more or less in a cash position while the markets reset. And it'll give you all that gunpowder to reinvest in stocks and real estate down the road. Yeah.
So, and you mentioned bonds, because I know you're very bullish on the dollar, the U.S. dollar, and I want to talk about that because a lot of people are not, and they're saying that the dollar is going to collapse, and we've got the BRICS with the threat of their currency, but so what you had just mentioned about being in bonds, at least being a safe haven right now. So when people are pulling their money out of the stock market, I know back when the stock market crashed, I think it was 2007, in the beginning of sort of the GFC, they were one of the last fueling drivers to the housing market, where people were taking the rest of their money. They were selling their stocks at a loss because they had already lost a lot of money. I know people that did this personally because I was in the housing market. I was helping them buy real estate. They were taking their money out. They're like, man, I lost 20% or 30% of my portfolio. I'm yanking it out because I'm afraid I'm going to lose it all. And then they jumped into the housing market, which just continued to push that last, effort of, raising the prices on real estate. And these were the ones that were really the most vulnerable because once we saw the real estate peak and then it tanked. But that was really the first time in history, at least modern times, that, post World War II, I don't know what the real estate business was doing prior to that. But when we look at real estate trends post World War II, we had never seen a decline in real estate. I mean, there were little dips and things like that, but we didn't see the kind of crash and so these investors, they took their money out of the stock market at a loss. They invested in real estate and lost there too. Mm-hmm. And for many of them, they were just devastated and bankrupt. Do you think that the majority of investors have realized now that this real estate bubble is way bigger than the 2008 bubble? Or leading up to that bubble. Mm. And do you think that they will, push into the bond markets more, or do you think they're going to make the same mistakes and give that real estate market an extra push should stocks start to dip?
Yeah, that's a tough call. I mean, pretty much the herd mentality. Always they repeat the same process. So I think if the stock market starts to stall out, we might see a push. We are seeing a little bump. Real estate's been holding up a little bit here. I think people are getting worried about the stock market. We had one big selling day in the big techs a couple of days ago, and more or less that sparked a lot of people talking about real estate, saying tech is done. It's time to move back to real estate. It could push a little bit of a bump. Unfortunately, the masses are usually going to do the same thing. Once they get burned on something, they move to the next, and it might push real estate up a little bit. But I really feel like it's really topped. I think if anything, it might hold its value, maybe squeeze a little bit higher, but not to new highs, and then eventually roll lower.
Yeah, that's a scary thought, especially if we see the Fed, even though their overnight trading rate doesn't really affect a 30-year fixed rate mortgage, it will have an effect on investor loans, what investors can, borrow money. And if we see another push in real estate where these asset prices could go up even further, that would be really devastating for people hopeful to buy a house in the next year or so. But let's turn to the dollar because I know you like the U.S. dollar. And many believe that U.S. debt at almost $35 trillion, that the appetite for foreign investors to invest in our debt has eroded. And many believe with the threat of the BRICS nations, their new currency, or I guess what they're talking about, if they ever do produce, go forward with this BRICS currency, that the U.S. dollar could really be in trouble. I mean, what are your thoughts on that? Would the BRICS, definitely creating their, this BRICS currency, would that change your position at all on the U.S. dollar?
Well, yeah, probably not in the near term, but long term. So, I mean, I've been in the precious metal space since like 2001. And I have been hearing people talk about the dollar is going to collapse and be worthless forever. Like it's never ending story. I'm bullish on the dollar because I tend to see when kind of the economy falls apart, global economy, the US dollar index, which is what I follow and trade, tends to rally in value. And so I believe there's good opportunity there. I believe it's going to rally probably. The US dollar index, I think it can move up to about 115, 120 and change, which isn't a huge gain, but it's a nice low volatility way to park your money and watch it go up in value. And I think that's only going to happen until we have a financial reset. Once the financial reset happens, just like actually very similar to the tech bubble, I think the dollar will get beat up for years and it'll fall in value and it'll be out of favor for a long time. I only like the dollar for like the next year and a half tops, probably. And then after that, I'll probably be moving actually my capital, which right now is in US dollars. It'll be probably back into Canadian dollars because I think the Canadian dollar will do very well. And the dollar itself will fall and the dollar index will lose value. There's going to be all kinds of stuff coming, I think, with BRICS and cryptos. I think there's going to be a lot of stuff coming into play. I heard talks of a new blockchain exchange for trading physical gold, that there's actually gold there. So it's a real currency that's backed by something. So I think there's a lot coming down the line in terms of currencies, alternate currencies that, so I think the dollar has probably had its time to shine. I think it's got a little life left in it, but I'm not the most bullish on it long term.
Interesting. What do you think will happen to the U.S. economy at that point? I mean, obviously, do you think that we'll remain the world reserve currency, or do you think that that's at risk too?
That's probably going to be at risk. I don't get too much into the whole global economy and the currency space. Again, I follow price. I have the pocket of assets that I know and I understand. So I don't know what would take its place. I don't think it's out there yet, but I think they're going to struggle and they're going to definitely lose buying power. There's been definitely a lot of transaction going on in US dollars. I had a meeting this weekend with some very interesting investors, and it seems like a lot of countries are actually, there's a lot of transactions. I think transactions in US dollars is up like something like 30 or 38% for global trade. And when they talk about it, they said it actually looks like all these countries are doing these trades to get rid of the dollars and to take on commodities and other assets because they don't believe the dollar is going to be around for very long. So It's going to be interesting.
Interesting.
I mean, you can go down a
Credible
dark
people
rabbit.
you were talking with. These
Yeah.
are smart, credible people that you met with.
Yeah. Oh, yeah. Yeah. So it's interesting because I don't get into that side of things. I really keep it really high level. Look at the charts, look at price, let's follow momentum. Let's see what all different assets are doing because everything's related, right? If the stock market's going down, that money's flowing somewhere else. It could be the dollar index, it could be bonds, could be going to real estate, could be going into whatever. So I follow a whole bunch of different assets, and I track the money flows and how much is flowing at certain times. And depending where money is flowing, is it a defensive sector? Is it an aggressive sector? Is it, you know, depending where it's going, I can say, okay, well, everybody now is this scared, and this means this should happen. So that's what I follow. I don't get into like the politics and the currencies and what could unfold if new policies come into place. It's out of our control anyway. So I don't focus on that stuff.
Yeah, makes sense. Well, let's talk about bonds because I mean, a lot of people believe that that's the safest place to park their money right now. You have a chart on your website, thetechnicaltraders.com, that talks about from bull to bear, and it's really addressing the 10-year treasury rates. Can you kind of give us an overview of this chart and what you recommend with the 10-year treasury?
Yeah. So, I mean, we've obviously seen the treasury rate falling for the last, 40 years. Everybody's just been, complacent in terms of, hey, if the stock market's going down, just move to bonds. That's why they created the 60/40 portfolio for investors. So if one's going down, the other should hold value or maybe go up a little bit. Um, and all this chart is showing us here is that the long-term rates have gone from falling to now rising. And when rates rise, bonds go down. And of course, that's what we've seen. Bonds are down like TLT and ETF to trade the long-term treasury bonds are down like 40 something percent. They've had a huge correction. And right now we're in rising rates. I think rates are going to hold their value. A lot of people keep saying they're expecting them to get cut any day here. I don't think they're going to get cut till we have any blood in the streets. I don't feel like there's actually that much pain on Wall Street. I don't think there's that much pain in the real estate market yet. And the Fed doesn't do anything. They're more reactionary. They won't do anything until somebody gets hurt, and they're getting hurt a lot. That's my belief and what I've seen in the past. So right now, rates are going up. They might even squeeze higher for all we know. And that means bonds are under pressure. A lot of advisors.
So you don't think the Fed will cut in September?
If they do, it'll be a quarter basis point. It'll be something so nominal. I mean, I don't see why they would myself, but it's going to be so tiny. We got a high rate now that a quarter basis point, it really is just telling them that the trend maybe has changed. It will spark definitely some movement in asset classes, but I don't think there's going to be anything severe. I don't think they will, to be honest, but that's not my place. I don't know that space at all. Yeah. But right now, the bond market advisors are piling people into the bond market. I've talked to a lot of advisors all the time, and you look at the volume of money moving into the bond market, like the bond ETFs, everybody's moving into them trying to pick the bottom. And that to me is a warning sign. I'm like, okay, so if everybody's already positioning in bonds and everybody thinks they're going up, a lot of times the market goes the opposite direction. We've actually seen this several times over the last couple of years where bonds looked like they were bottoming, tons of volume moved in, and then bonds just kept making lower lows and kept selling off. So we might not be there yet. The Fed could easily hold rates or even put them up another quarter basis points, throw everyone off guard. Bonds take a hit. I don't believe you should be in bonds yet. Bonds, you're still trying to pick a bottom, and I don't do that. I wait for something to turn around. I don't care if I miss the first 10, 15% of a move or more. I want to make sure there's a strong trend in place. Everything supports it, that this trend has legs. It's not just a bet that it's bottoming. So I never get in near the bottom. I always let an asset top and start to move down. It has to prove to me that it's going in a downtrend. And once it's in a downtrend, I'm like, cut loose. Let's go find the next wave, the next asset to hop on in the market.
Yeah. I know you said that you try not to get involved in the politics and following that, and going more with what you just said. You're looking for trends and letting them really show the support, not just maybe, a bounce or, a quick drop as an indicator that's where you should be moving into. But is there anything that concerns you politically or geopolitically, like in the back of your mind? I mean, you move a lot of money, right? And you're responsible for a lot of money. I mean, is there anything where you're kind of thinking at night, like You're hearing headline news. I mean, look what just happened this past weekend, right? With the attempted assassination on Donald Trump. I mean, is there anything that you worry about that would change the way that you think about your current business?
Not really. I mean, all politics and news and geopolitical events, they're all out of our control. We never know when they're going to happen. Economic data is all random. Really, I focus on price. I think maybe if like a nuke goes off or something like that, that'll be a game changer because that's threatening people's lives. It's threatening Earth. I mean, like it's huge, right? And we could see energy prices skyrocket. We could see food prices skyrocket because everybody's going to go into protection mode. Gun prices will go up. Gun stocks will take off. Gold will take off. So unless somebody literally drops a big bomb and cracks something wide open, which we don't know what that is, and we never know if it'll happen. I don't really try and think about it. I don't like to go down the doomsday and the big scenario because it's pointless stress, and I'll deal with it when it happens, if it happens. But right now, no. We just follow price. I know there's going to be difficult times. The question is, how do you navigate it? And there's all kinds of ways to navigate it safely. You can literally just sit on the sidelines and let things collapse and reset, and you could sit there earning interest on the side until the dust settles. Like you don't have to try to totally avoid it and profit from chaos. You can just step aside and be happy and live your retired life, and then have all that capital that when you're like, you know what, I feel like it's time to buy something. I want to buy this. I want to buy that. So there's a lot of ways you can go about dealing with this crisis. It's not the end of the world. It's just going to be a financial reset. We've had tons of them in the past, and people get hurt, they recover, and it's just an opportunity.
No, I think it's a great common sense approach, and obviously you're successful. Lastly, I want to kind of talk about our youth. You started out, I think, cutting grass, right? I mean, it probably helped your dad when you were growing up with all of his properties and maintaining, and you started a lawn care business, which is amazing that you've always been an entrepreneur. But what do you say to the young people? I mean, a lot of people feel that the baby boomers, have burned them and really put them, that they're paying now for a lot of the mistakes from their parents and their grandparents. What do you tell young people to stay positive? What kind of advice do you have for them?
I think I love learning. I'm always learning. I've got an incline trainer. I hop on it. I don't go on it unless I have a course or a video on YouTube. That's, I love to learn. I don't like to waste time being entertained so much. I do that with my son for movie nights, but I love learning. The more you learn, the more opportunities in the world open up, the less stress you have, the more the world just becomes available. And I think whatever has your interest, doesn't matter what it is, just jump around and learn whatever it is. Like the internet's amazing. For $15 or $20, you can buy a course on, any online schooling website and learn it in a weekend and become literally almost a pro. And you can do that with hundreds of stuff. I'm always learning. I think education, following your passions is the key. Everything I do is stuff I love. I don't know if I love it because it makes money or if I actually love it. I don't know. I love what I do. I love real estate and self-storage. I love stock trading. I love running businesses. I love trying to keep things efficient. That's just who I am, and that's all I do. So people should just follow whatever makes them passionate and just keep learning about it. And if you keep educating yourself, opportunities and people will approach you saying, "Hey, I got this idea. You seem to know about it." It's amazing when you have education. Opportunities seem to just knock on your door. Whereas people who just watch endless TV at night, stuff doesn't happen. Like you're just burning time. So the more you learn, the more people you meet and connect with, and the doors just get kicked wide open. And that's where all the fun opportunities are. Like I love working with entrepreneurs. I do a lot of philanthropy. I help run a fundraiser for 100 Men Who Care. We support all kinds of charities every year. I help other kids get into real estate. I'm helping a kid right now, saving up and talking about him buying his first duplex, a small one, and he lives in it, the little one, and rents it out. And he can learn property maintenance and learn the whole thing, right? He's about 2 years away from hopefully being able to buy his first house. So I love it. I just love helping individuals. And I think the key is passive income. I think your first real estate property as early as you can, ideally a duplex or up, so you can live in it and have tenants, is the way to get started. And I mean, timing for this boy will be perfect because I think real estate will be fair valued and it'll be great.
That's awesome, man. You sound like a great mentor. Chris, how can people follow you? I mean, you have YouTube. We're going to post all of your information in the show notes for people to go over, subscribe to your YouTube channel, which is great, by the way. You're giving great free information. But how can people, follow you, learn more about you? What's the best place for that?
Yeah, they could go to my website, which is thetechnicaltraders.com. I have a free newsletter. If you get on there, you'll get updated whenever I do a YouTube video, which I share a lot of stuff you and I talked about. I go through charts. I cover all kinds of interesting things there. All the trades that I put on or that I offer, I trade ETFs, are all trades that I do with my own money. So I built the strategy to manage and protect my own capital, and I share it with everybody else. So we're all like-minded individuals. We're all maintaining and protect our wealth. We're all into real estate and precious metals and the stock market. And we're all about just shuffling around as the markets unfold. We move back and forth into various assets. And my strategy is called CGS, Consistent Growth Strategy. And that's what we do pretty much every year or every quarter. Our wealth is going up no matter what the stock market does. It really blows people's minds because we're only holding assets going up, or we're sitting in cash collecting interest and dividend payments, which is still our account going up, just not exciting, but growth is growth.
Yeah, well, Chris, thank you so much for your time and look forward to having you back again.
It was a pleasure. Thanks for having me.
Talk soon. Well, thanks so much for making it to the end. If you like this interview with Chris, you can let Chris and I know that you did by hitting that thumbs up. And if you haven't already subscribed to Sachs Realty's YouTube channel, consider doing so now. Hit that alert bell. You'll know every time we upload content just like this. And one of the biggest compliments that you can do for me here at Sachs Realty is to share our videos and our YouTube channel with your family and friends. That's one of the ways that we can continue to build our community together. And I love to hear from you. So if you care to, drop your comments below. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.